Hey, good afternoon, everybody. Chris Lester here. Welcome back to our weekly chat with Chris. My name is Chris Lester. I'm going to be your presenter today. And for those of you that know me, welcome back. And I hope all is well with you. And for those of you that don't, we may have some advisors on here that we work together collectively. And maybe they've invited you to this call to listen in because we're like-minded. So I welcome those as well. Every week we try and bring subject matter and topics that are important and relevant, sometimes maybe a little intimidating and confusing, and try and explain them in layman's terms so that you get a better handle on what else is possible and maybe a different perspective on some things out there. So today's topic is assess your risk, right? And risk can have different meanings depending on what context we put it. So obviously, if we were to refer to maybe risk of driving, right, we could have an accident, and maybe compared to our health, risk of getting ill or sick. But it is signified as loss. And today, we're going to assess risk of loss and risk of from a financial perspective. So the first term I'm going to use is something called unsystematic risk. In a case study. So unsystematic risk goes back to an age-old analogy, which is don't put all your eggs in one basket. If I were to ask all of you, and you don't necessarily need to respond, but intuitively we know that if we were to walk out to the hen house, put all the eggs in one basket, and we walk back to the kitchen, there's a risk that I could trip and fall. I could stub my toe on a rock, trip and fall, and I could lose everything. That is akin to unsystematic risk. And from a financial perspective, this proved itself back in 2007. There was a company called Citigroup, and the stock symbol was C. And you can see that as the meltdown of 2008 occurred, that virtually overnight, this stock became nearly worthless in the span of a year. That is why mining for gold is risky. People have gone bankrupt chasing that next Bitcoin. Not saying that there isn't value there, but having everything you own and betting the farm on it typically is not a good approach. So the solution to unsystematic risk is something that maybe you've heard of. It's called asset allocation. This is investing in a broad range of companies and sectors in an effort to decrease the risk and increase the return, while accounting for individual investor risk tolerance and financial objectives. So you might be familiar with a pie chart that might look something like this. This is an example of asset allocation. So the green, you have a little bit of cash and maybe a little bit in U.S. stocks and a little bit of non-U.S. stocks, and about what I like to call a CYA, cover your butt approach to financial strategies from a lot of the financial institutions. They can say, well, this was the person's risk tolerance and this is what they selected. And it does work to a degree, because if you take that example of Citigroup that we used before, and if we were to blend that in to a myriad of other stocks, you can see that now Citigroup is owned under financial services, and it's only a percentage of an overall portfolio. Therefore, it's a risk. But is asset allocation really enough? Not if we want to protect against investment risk number 2. And that is called systematic risk. And that's risk that's inherent to the entire market. And the example or the analogy that I use, I would say instead of us having all of our eggs in one basket, what if I gave every attendee here an egg and you put it on your desk? Representing diversification, you could arguably say that if the person in the front row all the way to the left were to accidentally drop their egg, it would not affect the other eggs in the class, unless something like an earthquake were to happen. So that is systematic risk because an earthquake would affect all the desks simultaneously. And that's akin to examples of war or 9/11 or inflation or COVID-19 or recessions or depressions, right? To understand the dangers of systematic risk, let's examine the performance of a well-diversified portfolio from 2004 to 2009. So let's say you had a stock portfolio that was equally weighted into these 25 indexes. We'll call it the Russell 2000, small caps, 25% of the portfolio was in there. Then we have 25% into the Dow Jones Industrial Indexes. Then we have in the tech sector in the NASDAQ, so 25% would be there. And then 25% into large cap, which is S&P. So let's just say that you were balanced that way. You could arguably say that doing that investment strategy that you would have ownership in over 2,600 stocks. You could arguably say that that's well diversified. But is it true diversification? Well, this whole portfolio, had you done that between 2004 and 2009, fell off a cliff in 2008 heading into 2009. So asset allocation or traditional diversification alone was not enough to prevent against catastrophic loss. So again, we see the typical advice that we get from plan administrators, third-party administrators. Typically, if you work for an employer, they'll send somebody in maybe once a year to help you to make sure that your account is allocated correctly. And the theory is the closer that you get to retirement, the more money you should have in bonds and less in stocks, right? So that's traditional asset allocation. But if you own investments that move differently from each other, that's called low correlation. And so again, the theory is that, if you look on the screen here, you see that maybe the orange line, which had early in an early time period, had some high returns, but that dark green line at the bottom was negatively correlated. But as we progress through times, we can see that each of these assets might react to each other differently. This is akin to spaghetti, right? And what it's trying to do is having these low correlated vehicles helps to smooth the portfolio lines so that that's where you get that dark red line in the middle. You don't get too high, you don't get too low, but we can start to expect reasonable rates of return. But when events like 9/11 or the housing bubble burst or COVID-19, all items tend to become correlated and the bottom drops out from them. This is what this is showing. So not necessarily is asset allocation enough. So Harry Markowitz, he's an economist and created the modern portfolio theory, and he says, a good portfolio is more than a long list of good stocks and bonds. It is a balanced whole, providing the investor with protections and opportunities with respect to a wide range of contingencies. So I show up here on the screen a thermostat, and suppose you're, in a COVID-19 environment today, you are sitting there in your house because we can't really get around too much, and all of a sudden, your air conditioner breaks. It's 100 degrees in your house. What do? Well, if you follow a Warren Buffett approach, you could wait it out. You could wait till the fall or wait till the spring, and the temperature will eventually start to even out inside. That's called passive management. You could also take an active approach, and that is you could call a repair person and let them come look at it. Neither is right or wrong. They're just different, and helping you to understand that when you hear terminology, everything has a purpose, and as long as you understand what it is we're trying to accomplish, it allows you better to be in a frame of mind that says, okay, this is the right approach for an investment strategy for me. So now this is going to lead us into a game that we're going to play. And this is actually one of the greatest games ever invented because I made it up. So humor me here. Let's say that you're working for an employer and unfortunately you were let go yesterday. But never fear, you had great skill set. Actually, you were renowned in your industry and you were highly sought after, and another competitor picked you up the next day, today. The only thing is that in order to come on board with this company, you must roll over 100% of your existing 401k into the company's new 401k. And their only options for investment were two portfolios. You either had portfolio 1 or portfolio 2. Now, the only piece of information that you know about either of these portfolios is their rate of return. One has paid an average rate of return of 6.43%, and the other has paid an average rate of return of 6.4%. What portfolio typically are most people going to pick based on the parameters in that just given everybody? Number 1, right? 6.43. That's obvious. All right, now I'm going to give us another piece of information. That other piece of information is portfolio 1 uses an investment firm named Vanguard. Heard of Vanguard? I mean, you can go on the internet and you can't find anything negative about Vanguard. And then portfolio number 2 is ABC Investment Advisors. Now, based on this additional piece of information, who we're probably going to go with? 1. We're with 1, right? Okay, now I'm going to add one more piece of information. And what is Vanguard known for? Low fees, typically between 20 and 40 basis points, versus maybe ABC Investment Advisor charges 1.5%, right? Average fee. Now, based on this whole picture, who are we going with? And again, 1. This is what everybody has as portfolio 1. Now let's put some numbers to these and let's start to look at it. Now I'm going to come back to Sharpe Ratio, so put that off in the back of your mind. But let's just say from 2000 to 2018, 19 years, you take those rates of return. This is the S&P. Turn around, we total them all up, we divide by 19, and that's our average rate of return, 6.43%. Versus a portfolio managed with a little bit of active management turns around. Now it goes from 2000 to 2018, but it's 6.4%. All right. Now let's put some numeric values to that. Let's say in 2000 you had $1 million, and this is the year retired. And what I typically say here is, let's say that you call up Bill at one of your local name brand investment firms. We'll call it Wells Fargo Wealth Management, and your Bill is your investment advisor. And you turn around, you retire, and $1 million in the first year into your retirement, you can see by the end of the year the portfolio is going from $1 million to $900,000. Now you call up Bill, and what does Bill tell you? It's just a paper loss, right? Hang in there. We're in it for the long haul. But what else are you going to do? So you turn around and you go, okay. And next year, something happens that wasn't expected, and the market is down again. Now your $900,000 portfolio loses almost 12%, is down to $800,000. And then 2002 hit. And now it's 22%. And you're in 3 years into retirement, your portfolio is at $623,000. And what happens when you call to speak to Bill at Wells Fargo at this point? What happens? They go, Bill doesn't work here anymore, right? So all the pundits would tell you, yeah, but wait, it'll come back that 28%. And notice even with the 28% rate of return, we're still not back to even. But let's just look at the math and let's just total this up all the way. The ending balance is $2.4 million. And who wouldn't like that kind of return over time? If you can buy and hold, that's again the Warren Buffett approach. Over time, things will recover. All right, let's compare that to portfolio 2. Now portfolio two, you turn around and $1 million in year one, but you know what? You actually, with a little bit of active management, we got a little bit of rate of return during these times. Now, at the end of that same 19-year period, portfolio here did $3 million, right? Almost 3.1. Now, I don't know about you, but to me, $600,000 difference there is real money. So, what's the difference, right? And the difference is it's the rate of returns. But now we're going to introduce you to something I call the commutative principles of mathematics. This is something that we learned a long time ago. We know intuitively, but we don't think about it in terms of our finances. So, what's 1 times 2 times 3? It's 6. What's 2 times 1 times 3? It's 6. So 3 times 2 times 1. What's the answer? It's 6. My question is, if I change the order of these investments right here, will my results change? And the answer is no, because of commutative principles of mathematics. When it comes to multiplication, if you change your rate of return, the sum at the end of those two time periods would be the same in both examples. Where it changes is when we take a withdrawal out of our accounts. If I take a withdrawal out of my account and now I'm actually in retirement and I need 50 grand a year to live on out of this account, not only did portfolio one lose 10%, 9.1% in year one, but I had to take out 50 grand as well, and now I've locked in that loss. And at the end of that 19-year period, that portfolio is at 329,000 versus portfolio two with some active management is at 1.3. Now, the question I have for everybody now, based on that, which portfolio do you want now? And we want two. Everybody, when you're working and at your employer, has portfolio one. And the reason is because that's all they offer there. So they're starting to wise up and offer self-directed options. But this is the problem with most of America and their investment strategies. So now what I'm going to do is I'm going to introduce us to standard deviation. I told you I was going to talk about Sharpe ratio, and I'll come back to that number. But standard deviation is basically it's a measure of variability of results. So if we look at the bell curve and we go back to our statistics class when we were in college, what it basically says is that one standard deviation is 68% of the time will either be the left or right of the mean. So in this example, the average rate of return is 7%. The sigma, or the standard deviation, is 13%. That means that one standard deviation that the portfolio could have plus 13%, or we could get 20% one year, or we could do a negative 6 if I got a minus 13%. But 95% of all portfolios happen within two standard deviations, or two standard deviations happen 95% of the time. Is a better way to say it. So if I add another 13% to 20, I'm at 33. But the downside now increased to 19. And then if we had a third standard deviation, which can happen 98, 99% of the time, now we're at 46%, which is, okay, I'm swinging for the fences, but oh my God, I just lost 32% of my portfolio. So, if you had $1 million and had a swing of negative, 32%, right, that would leave us with like $680,000. The second term I want you to learn is beta. Beta is a measure of volatility. So if we turn around in our beta, basically the market is one. So if you think of the market, let's just say we're going to use large caps, US S&P, that if you have a beta of 1.5, it just means that the market is 50% more volatile. It means it can go up and down just more frequently. And that is something that has happened within almost a daily basis with the market now. Volatility is here to stay. And it's a measurement. So when we're looking at our portfolios, we want to, say, hey, can I not have as much swing in my portfolios? And then lastly is Sharpe ratio. Sharpe ratio is the risk-free rate of return, which is sort of your treasuries right now, minus the average rate of return divided by standard deviation. Or in plain English, are you being rewarded for the amount of risk that you're taking? We like to see Sharpe ratios of about 0.5 or higher. Now, everybody that's on this call, typically, we believe in a philosophy called results in advance planning. I can charge anywhere from $600 to $1,500 for a series of reports, financial plans, put them together if you would like. But if you're on this call and you want to see what your portfolio looks like, what a current position looks like, this is somebody that brought their portfolio to me, and they're in the traditional 401k. And when we measured it, look at this number over here to the right, this risk. This is their standard deviation. Their average rate of return on their portfolio is 3.8%, yet they're taking 15, almost 16% standard deviation, and that's just one standard deviation. They go out two, right? You add another 16% to that 19%. Yes, you're swinging to the fences, but on the downside, now you could turn around and on that 12% add another negative 16%. So this was the picture of this. What could happen if 2008 happened again? This portfolio could have actually a loss of almost 55%. That's at zero to right here. It's sort of hard to see, but this is a little red box right here. So all we're saying is, look, we believe in the market, that when you're going to be in the market, there is risk. We could lose money in the market. And our goal is over time, we're going to make money. But if we can shore up some of that risk, put in strategies where we start to get more of a return or expected income into our overall planning as we're approaching our into retirement, doesn't that make a lot of sense versus turn around and put it into the market and just have it evaporate? So it depends on where you are on the timeline, on the horizon. But if you'd like a report like this, either get with the advisor that invited you here today, or email us. I'd be more than happy to. I just have to ask you some pointed questions, but I'd be more than happy to run your risk tolerance, your risk assessment. It's called an in-stream report, and like I said, at no cost to you, just to help you to understand what your overall risk is of your portfolio. I want to thank all of you for being on the call. I hope everybody is doing well. I hope you're finding these weekly sessions informative. And don't keep me a secret. If we can be of assistance in any way, any questions as it relates to finances or things in general, pick up the phone and give us a call, shoot me an email. Glad to help. And guys, thank you so much for showing up today, and stay well. Have a great day.